Last Wednesday, 14 lakh crore rupees of Indian investor wealth evaporated in a single trading session. The Nifty 50, India's benchmark stock index, collapsed by 775 points before the closing bell. A violent alignment of surging oil, fleeing foreign capital, and a leadership vacuum pushed this session far beyond a standard correction. Inside the trading floors of Mumbai, the atmosphere was paralyzed. Traders stared at screens flashing deep red across nearly every sector, trying to make sense of a market breaking from all sides at once. For those holding Indian stocks, the instinct right now is to sell. This is a story with 4 moving parts, and each one matters to your portfolio. A highly specific set of global macroeconomic shocks and local microeconomic crises collided on a single day, creating a rare alignment of destructive forces. The first domino fell in West Asia. A sharp military escalation involving the US, Israel, and Iran sent Brent crude oil surging past $110 a barrel. Because India imports over 85% of its crude oil, this exact shipping lane dictates the country's economic baseline. Every $10 increase in the price of a barrel of oil adds roughly $15 billion to India's annual import bill. With prices now $50 higher, the country suddenly owes the world an extra $75 billion this year. That massive expense acts as an invisible tax on the entire domestic economy. When oil prices surge, the cost of manufacturing fertilizers, mixing paint, pouring cement, and shipping goods all skyrocket, driving up inflation across the board. While India had no control over the military triggers in the Gulf, the resulting inflation squeezed corporate profit margins and terrified local markets. That inflation data triggered the second domino. Reacting to the energy crisis, the U.S. Federal Reserve paused planned interest rate cuts, citing upside inflation risks. When the Fed signals caution, global finance enters a risk-off environment. Foreign investors immediately liquidate their positions in emerging markets and move their capital into the safety of U.S. government bonds. We can see the violence of this shift in this comparison chart tracking foreign portfolio investment. In February, foreign investors bought 12,000 crore rupees worth of Indian equities. By the second week of March, they had pulled out an astonishing 52,703 crore rupees. When billions of dollars exit the country that quickly, the local currency absorbs the impact. The Indian rupee fell to an all-time low of 93.49 against the US dollar this week. Foreign capital is fleeing emerging markets globally, but the local consequence makes essential imports even more expensive, locking the economy into a self-fulfilling inflationary cycle. The third domino fell inside a single boardroom in Mumbai. HDFC Bank is India's largest private sector lender and carries immense systemic weight. Because it is the second largest stock by market capitalization, its movements drag the entire benchmark index with it. Right as the oil and currency crises peaked, HDFC Bank announced the abrupt resignation of its chairman. There was no transition plan provided and no reason given beyond standard regulatory filings. This line chart tracks the immediate market reaction to that uncertainty. HDFC's stock price took a sharp 5% nosedive on the news. Because of the bank's massive weighting, that single drop was responsible for erasing 130 points from the Nifty index all by itself. Investors were already on edge. Earlier in the week, the bank terminated senior employees following an internal probe into the alleged mis-selling of AT1 bonds. AT1 bonds are high-risk debt instruments that can be entirely written off if a bank faces financial distress. HDFC's financial fundamentals, including credit growth and asset quality, remained stable. The market sold the stock because a sudden leadership vacuum acted like pouring petrol on an already burning fire. The market ticker reflects immediate fear, but the internal gears of the economy continue to turn. With banking credit growing and retail demand holding firm, the structural drivers of the digital economy and infrastructure spending remain operational. This sell-off represents a repricing of the narrative. Investors who previously paid a high premium for Indian growth are now discounting those same assets to account for global fragility. Look at this historical line chart of the India VIX. The VIX is a volatility index that measures how much fear traders are pricing into the market. Right now, it is elevated above 22. But as this chart illustrates, historical spikes to this level mark the exact periods where patient buyers are heavily rewarded in the subsequent long-term recoveries. Navigating the coming weeks requires a focus on 2 specific signals: oil price de-escalation, and the avoidance of panic-driven sales based on a single week of bad news. Reassessing sector exposure is also critical. Businesses that rely heavily on crude oil derivatives, like paint manufacturers, cement companies, and airlines, are the most vulnerable to this specific macro shock and require careful review. The geopolitical noise right now is deafening, and the market reactions are violent. But holding steady through the storm and relying on data rather than fear is the only way long-term wealth survives.